Hi friends, this is RB Ashwini Rastogi. So basically, we are a registered valuer, we are expert in valuation. So why valuation is required for you? Let us understand in small video. So suppose when the valuation is required, now valuation is much important in every phenomena of why our valuation is required. So fresh issue of shares and transfer of shares, there is required for valuation. Suppose you are already carrying your business, you looking from some investor to invest in our company, then since you have to issue some fresh shares or some transfer of existing share to those NRI or resident, then investor is required. What is your valuation? So we have to provide a valuation. So valuation is also required as per the law. From the company law required minimum value, that valuation is required from the registered valuer, and section 247 of the Companies Act read with the registered valuer rule says we required IBVI valuation certificate only. So another important aspect as per the income tax criteria is also there. So suppose there is a transfer of shares, so we need the valuation as per the 11 UA. So आपने अपना शेयर्स दूसरे को सेल कर रहे हैं तो आपको कम वैल्यू पे सेल नहीं करना. सपोज यू आर सेलिंग 450 rupees per share, but the valuation is come 11,000. You are selling only 450 shares, so you are selling at below the fair market value. FMB concept in the income tax says that the fair market value of that particular share is 11,000. You are selling only 450. So for the purpose of section 50CA, we will treat 11,000 as a sale consideration, fair market value of that share as a sale consideration. So seller will liable to tax capital gain on the basis of FMB. But what happened in case of buyer that is buying only 450, but the share worth is rupees 11,000. So section 56 to 10, section 56 to 10 says since you are buying below the market value, we will treat you notional income under the head of income from other sources. So this is important concept. From the seller point of view, it will be treated as notional income under section 56 to 10 in the income from other sources. From the seller point of view, it will be treated as capital gain. Sale consideration will be treated as section 50CA. So another important valuation is required, section rule 11 UA, 11 UC. In case of indirect transfer, we need a valuation from a registered valuer. We have to see what is the value of our listed share or unlisted share or any other entity. There is a concept for A plus B upon C. What is fair market value of that asset. From FEMA perspective also we required valuation. There is a FDI and we required to file form RBI. So for that purpose we required valuation from the IBVI registered valuer. So if you are a listed company, then there is a situation from the SEBI LODR provision is applicable on the basis of there is a concept of weighted average, volume weighted average market price over past 26 week or 2 week, whichever is higher we will take a price. If it is infrequently traded, then the concept is another thing. So in case of merger, there is a lot of amalgamation, merger is there, so business combination is there. We need to determine swap ratio. So this company is suppose amalgamated in this company and new company will form. We will distribute new company shares to the old merged company. So we need to determine the swap ratio. So swap ratio is x number of equity shares of XYZ this company paid for Y equity share for this company. This swap ratio is also need to be determined by us for the purpose of valuation of shares. Same way there is a some intangible asset is transfer. You buy some business, in that scenario business maybe you buy some business but you don't buy any tangible asset, only intangible asset in the form of goodwill or some customer contract. So in that scenario we have to determine business valuation, brand valuation based on the PPA method. So this PPA method we have to calculate the WACC and determine the valuation intangible asset of that company. What is the goodwill, what is the customer value. So in case of slump sale we have also need to determine ESOPs. So there is a concept for ESOPs. Suppose you grant some ESOPs to your employee, you need to determine the what is the fair value for ESOPs that need to be charged to the P&L account. So in that scenario you required for Ind AS 102 purpose valuation from the registered valuer. So in case of IBC, if your company is under the CIRP, so IRP who will become the resolution RP need to take a two valuation report from the registered valuer as per the regulation 27 under the IBC. So this is a requirement for financial reporting purpose as per the IFRS. In Indian converged version is Ind AS 103, where is a business combination, merger, acquisition or some amalgamation is there, you required to compute your intangible value. So for Ind AS 103 purpose you required valuation report. As I said, for ESOPs Ind AS 102 is required. In case of financial instrument, as per the Ind AS 109 you required valuation report. Some impairment is also required valuation report. Intangible asset case is also required valuation report. So this is the story for valuation report. So in cut short, when there is a transaction you must get a valuation report. You must disclose your asset at fair market price so that the true and fair view can be reflected. Thank you.